Welcome, everyone. I see some people are starting to come in. My name is Derek. I'm a CPA, founder at GreenGrowth CPAs. We're really excited to have everyone on the call today. Currently, we are a full-service CPA firm, so audit, tax, advisory. We have been in the industry now for close to 5 years. We recently received approval this past week from the Canadian Board of Accountancy, so we're really excited about that. We have about half a dozen IPOs that we're working on for our cannabis-related clients, so we can be the full auditor, both in the United States as well as in Canada. So for any of you who are interested in going public this year in Canada, it's a really good time to raise capital. Hey, Crystal and Meet from Brea, California. We're right down the street from you. We're actually based out of central Los Angeles, so we are right across the street from the Grove. Nice. Hey, Donna from Sebastopol. Great to see you. Hey, Josh. Welcome from Sacramento. We love Sacramento. We have a few dispensary-related clients up there. Great place to be.
All right, guys, we are about to start the webinar now. We're insanely excited to talk about the new changes in the tax laws that will be affecting your cannabis business. Because we are in tax season time, this is probably the most relevant time to learn about taxes. Obviously, no one wants to learn about taxes outside of tax season, but now that we are in tax season, it's really important that you guys understand what the new changes in the tax codes are so you are not overpaying your taxes. A little bit about us. We are GreenGrowth CPAs. We probably prepared close to 1,200 tax returns by now, well over 1,000, and we've done returns in all verticals: dispensary, distribution, cultivation, manufacturing, delivery, and testing. We have about 350 clients spread throughout 11 legal states. We just closed Missouri about 3 weeks ago, so we're really excited to have clients out in Missouri, and we're also working on a few Hawaii deals, which would be our 12th state. We have done at least 12 audit and valuation related projects in 2018 and 2019, and we hit 7 figures in revenues last year. So that was 2018, and that was our second full year business. So we've experienced tremendous growth, and we're really grateful for all of the opportunities that are presented to us. We have a thorough and deep understanding of tax, compliance, and assurance related to the cannabis industry. Pretty much anything that's boring will do for you. Just a quick reminder, and I'm sorry, but our lawyers make us say this, but the information contained in this webinar presentation is meant for guidance purposes only and is not construed as professional or legal or tax advice. Further, it doesn't give any personal tax advice or investment advice in any manner. This is simply for discussion and general points. So the agenda for today is we will identify and talk about the new changes in the tax codes that will be taking effect on this year's income tax return. Specifically, we'll be talking about filing Form 1120, which is C Corps. We'll talk about the Section 199A qualified business deduction income, which is without a doubt one of the best deductions that a cannabis operator could potentially take. And lastly, we'll talk about Tax Code 280E, which affects all Schedule 1 cannabis-related companies. Lastly, we'll also talk about how these changes in the tax code can affect your cannabis business based on the ownership entity structure. And we'll talk about strategies to maximize these changes and also use them to your benefit to help make sure that you're not overpaying either the state or federal government. So the changes in the tax law that are taking effect this year. The first one we want to talk about is Form 1120, which is applicable for C corporations. The best thing that happened is that the tax rate for C corps is fixed at a 21% flat tax rate. So whether you're making $100,000 or $100 million, you will be subject to 21% tax rate irrespective of how much money your company makes. This is different from prior years such that it was a tiered structure. So the more money your corporation made, the more taxes you had to pay. So having a flat tax rate is an awesome benefit of being a C Corp. However, you still will be subject to double taxation. So it's important to remember that. The second point that we want to talk about is the Section 199A qualified business income deduction. Entities that are not structured as C Corps, so if you're an LLC, S Corp, or partnership, you will be able to take up to a 20% top line deduction on your individual tax return. So this is an awesome deduction if you are a pass-through entity. So how this works is let's say you have $100,000 in pass-through income and you take that on your return. You could potentially write off $20,000 off the bat simply because of this new qualified business deduction income. So it's a fantastic opportunity to be able to take solid deductions for really no apparent reason other than this is the new tax code change. There's some specifics to the Section 199A qualified business deduction income. And there are some specific things that you need to be aware of as a cannabis operator. Unfortunately, according to Tax Code 280E, you cannot take any deductions or credits when you are engaged in a Schedule 1 controlled substance activity. So this deduction is not available to cannabis operators. What we've seen in terms of great tax strategies from our clients is that they'll oftentimes set up various operating entities. They'll set up an asset management company, they'll set up a leasehold company, and those companies will be structured as a pass-through entity, and oftentimes those companies may be able to take advantage of the Section 199A qualified business income deduction. So, it's really important that you work with a competent and qualified CPA and lawyer to ensure that you're structuring your entities in a way that can maximize these deductions while also following all the applicable rules. The Section 199A qualified business deduction income also gives qualified agriculture and horticulture cooperatives the opportunity to take advantage of the 20% top line business income. This is also applicable to any qualified real estate investment trusts, so they're oftentimes referred to as REITs and many other qualified publicly traded partnership business income. The calculations for the 199A business deduction income can be a little bit tricky. There are new 7 tax rates on the personal level. So what are the new personal income tax rate levels? It's 10%, 12%, 22%, 24%, 32%, 35%, and 37%. If you make too much money, you may not be able to take all of the Section 199A qualified business income deduction. So it's really important that you understand which deduction you can take on your AGI, also known as your adjusted gross income, that will not allow you to be subject to phase outs. Pretty much what the phase outs mean is the government is trying to say, hey, you make too much money and you're taking advantage of too many tax breaks. So irrespective of the tax code, you will be subject to minimum tax. They're also commonly referred to as AMTs, alternative minimum taxes. So it's really important that when you're working through your income tax return, you're working with someone competent who understands the ins and outs and is able to navigate you through the various tax law changes. So you're reporting your income correctly, but you're also reporting it in such a way that will help you take advantage of the tax breaks. Here's a basic chart of tax savings from the Section 199A deduction by marginal rates. So for example, if you are in the 10% rate, for every $10,000 of pass-through income, you can take off $200. Whereas if you're at the top marginal tax rate, 37%, every $10,000 of pass-through income. So what is pass-through income? It's income that comes on a K-1 that is either from an LLC or an S-Corp. You can take up to $740. So there's great potential tax saving advantages of Section 199A. So it's really important that you not only classify your income appropriately, but you make sure that you know where you're putting it on the forms to take advantage of the tax code changes. So calculating the 1099's tax savings through 199A. So someone who's in the 10% tax bracket will save $200, and this is dollar for dollar on every $10,000 of pass-through income. And this is just a general example so you guys get a feel for what the savings are. Obviously, each tax situation is specific to that individual, but we want to give you rough dollar amounts for how much this new tax break can actually reduce each dollar that you owe. Whereas someone who's in the 37% tax bracket will save about $740. That's in actual taxes, not deductions, for every $10,000 of pass-through income. There's a difference between tax deductions and actual tax savings. What we're talking about here is actual money that you would have to pay to the government that you now don't because of this new tax savings code. So it's really important that you understand how your cannabis business is being structured and also how to take advantage of this tax code ruling. And also making sure that if you are a high income earner and your cannabis business is blowing up, that you aren't subject to AMTs or potential phase outs. There's a couple strategies to maximize the 199A qualified business income deduction. And those are putting assets in separate service lines potentially, and then maximizing your wages paid to employees. There are specific phase outs for the 199A based on the W-2 payroll. So you want to make sure that you maximize your W-2 wages paid to employees to maximize this deduction. So what we mean by putting assets in a separate service company, such as a property company or an asset holding company, is, let's say, for example, you have a $10 million cannabis business in Los Angeles, downtown LA, but you own the building, which is worth $7 million in a separate entity, which is a LLC. And you also have all the assets in that LLC as well. So what are assets? Your grow lights, your grow build out, all of the machinery and equipment that you use on a day-to-day basis. So, if you're doing volatile extraction, it's your CO2 machine, all the associated assets that you use in the business, you put that as well as a property in a separate company. And then the cannabis business will then pay, let's say, $1 million every month to the asset company for use of rent as well as use of the equipment. And then under that situation, you can oftentimes potentially take advantage of the 199A. All that being said, you want to make sure that you check with your CPA as well as you check with your lawyer to make sure what you're doing abides by the rules and regulations and you're not skirt-tailing any potential regs. So 280E, we've beat this issue over the head many, many times, but pretty much it is a federal tax code that does not allow a cannabis operator to take sales and marketing related expenses. Quick caveat. According to the new hemp farm bill, hemp, which has its very specific definitions, is now no longer on a Schedule 1 substance. I believe it was moved to Schedule 5. So you will now not be subject to 280E if you are specifically a hemp farmer. Of course, though, what I hear from our clients, though, is that hemp is not as beneficial in terms of CBD extract as potentially CBD derived from the sativa cannabis stock. Of course, I'm no farmer, and this slide deck will not talk about farming, but make sure that you know where you qualify and making sure that you have a CPA that's competent and understands your business to be able to classify where your income should fall and what deductions your company can potentially take advantage of. So here's a basic example of an ordinary business in a cannabis related business. The main point to focus on is the bottom line, which is taxes at 35%. This is aggregate tax rate. So this includes, your state, if you live in a state that has state income tax and all the taxes across the board. You can tell by this example that the cannabis business pays a dramatic higher amount of taxes than a normal business would. Roughly we've seen anywhere between 5 to 7 times the amount of taxes a normal business will pay, a cannabis business is subject to. So it's really important that you understand what tax code your business is subject to and making sure it's being filed appropriately. The tax code is so much higher for the cannabis business because SG&A is not allowed to be deducted under the cannabis business where it is under the ordinary business. So it's really important to understand that SG&A, unfortunately, is a non-deductible expense and you're going to be taxed at the gross profit level, which is obviously much higher than the net income level. And SG&A stands for sales and general administrative, which is pretty much all your overhead expenses. So SG&A, it really comes down to your marketing expense, your payroll expense, your rent, your supplies, anything that your business incurred that does not directly benefit or is attributable to your making a product. Cost of goods sold is your best friend as a cannabis related company. It's the direct and indirect costs that go into producing the goods or services that you plan on selling. Since your cannabis business is not treated like any other legal business, the cost of goods sold is the only deduction that you could potentially take. So when filing your income tax return, making sure that you understand what can reasonably be classified as cost of goods sold and what's reasonably classified as a sales and marketing expense is insanely important because that will then dictate how much taxes you pay. Here are a couple examples of cost of goods sold and allowable deductions. So things you could potentially deduct is the products, the product packaging, the invoices for the cannabis sales, less any other trade or businesses, electricity bill, which is obviously very high for indoor cannabis cultivators, indoor water bills, which is also can be potentially high for cannabis farmers. And things that you potentially cannot deduct are payroll expenses, office supplies, your weed map expenses if you advertise on weed maps, and any other related marketing and promotional expenses are generally not deductible. How to best maximize your cost of goods sold? Be very, very specific in the job descriptions and the activities of your employee. So for example, this is where employee manuals become very important in an IRS tax audit. If an IRS agent comes and tells you that 90% of all your bud tender expenses are sales and marketing related, they're going to disallow 90% of their payroll. Whereas if you have very robust employee manuals that shows that, the bud tender will spend 50% of their time selling the product and the other 50% of the time working with vendors on bringing in new products, you can reasonably argue that 50% of their payroll should be deductible because they're not engaging in sales related activities. They're also engaging with vendors to bring on new products, which is generally a cost of goods sold expense. So it's really important you have very specific job descriptions and you have all the documentation that can back it up. And of course, if you need help with creating these documents, we'd be thrilled to help you. What's also very important is including the square footage of your facility and how every single square footage will relate to your business. So for example, if you do CO2 extraction, you want to make sure that the bulk of your processing facility is documented and it shows that, out of the 10,000 square foot you have, 9,500 square feet relates to CO2 extraction. And this will definitely help you and the tax auditor identify what is allocated to cost of goods sold and what's allocated to sales and marketing. Another really good way, and this is a very easy way to maximize your cost of goods sold, is to keep track of all your receipts and or all your bank statements. In this day and age, it's impossible to keep track of every single receipt, so at least having clear digital records is probably the most important thing that you can do to substantiate your expenses. What the IRS will often do is they'll go back and audit, 3 or 4 years ago, let's say 2015, 2014, and they'll go back to those years because they know that oftentimes cannabis operators don't have proper records dating that long ago. So it's really easy for them to say, well, if you don't have any backup documentation for your expenses, we're going to disallow all your expenses. And it's terrible because they're pretty much going to assess a tax at the top line of what you earn. So if your dispensary that does $2 million, they're going to multiply that by potentially 35%. And then those are the taxes that you have to pay. So it's insane. They'll also go back to early years so they can assess penalties and interest on each month that you underpaid. So, when they go back to such early years, oftentimes the penalties and interest will far outweigh the additional taxes that they're trying to make you pay. The second thing that you can easily do to maximize your cost of goods sold is just simply knowing what all of the taxes that your company owes and making sure you're classifying your income and your expenses appropriately. And the reason why we're discussing cannabis tax audits in so much detail today is because what we're seeing from our tax lawyers out of Colorado that we do a lot of work with is that the audit rate coming out of Colorado is close to between 18 and 21% based on anecdotal insight. That is a really, really high percentage. Generally speaking, corporations are being audited at anywhere between 1% to 3%, but as you can tell, cannabis operators are disproportionately being targeted, and it's very easy to find a cannabis tax return. All you have to do is match the EIN on their state license app with the EIN on the return. So they're really easy tax returns to pick off. So it's really important that you make sure you're working with someone competent and you're also keeping all your backup records. Some last cost of goods sold best practices is creating separate general ledger accounts specifically for your cost of goods sold. Set up a system of checks and balances for verifying that all the cash flow ties back to your general ledgers. Setting up internal controls to prevent fraud and theft, which unfortunately is very rampant in this space. And the last thing you could do is making sure you reconcile your general ledger with the account transactions and keeping a strong paper trail with receipts signed by vendors and also the pay slips signed by the employees. So some key takeaways from this presentation is cannabis business owner entities could benefit actually from the new tax law. It's, oftentimes with taking into consideration 280E, it just seems all bad, but there's actually some good things under the new tax law. And understanding how to report the numbers and itemizing deductions is really the key advantage of taking advantage of the new tax law. So with that, if you want to make sure to maximize your cannabis business taxes in 2018, please feel free to contact us. We'd be thrilled to help you in any way we can. So please reach out to us either at greengrowthcpas.com or give us a call at our 800 number, which is 1-800-674-9050. I am Derek Davis, one of the CPAs of the firm, and I hope to hear from you all soon. Thank you.